Well, it is 5 o'clock. Thank you, everybody, for coming. We will get going on our market and economic updates. So far, as we've been doing this is our most attended seminar that we've done. We had a big crowd this morning and a decent crowd this afternoon. So thanks for coming. And I'm just going to turn it right over to Max and we'll get started right away.
Okay. So we're going to start with just some a market snapshot, talk about performance so far this year, and then a little bit of economic update, talk about interest rates, inflation, some of those things that we hear a lot about. So first, just talking about where the market's been so far this year. So this is as of yesterday, about midday. I think Lily took this snapshot. So at that point, we're looking at the S&P 500 here. So when we talk about the overall stock market, we're talking about the S&P 500. So this is the broad market index. It has 500 US-based companies, the biggest 500 companies in the United States comprise of this index. So when we're talking about the stock market, usually we're talking about that S&P 500. So as of yesterday, we were up about 9.5%. Today, the market was down another percent, give or take. So, but still halfway through the year, really strong performance. But as you're probably well aware, and as you can see from the chart, it's not been a straight line up. Beginning of the year, we were up a good 4%. And then we had this really steep drawdown from about middle of February to the very end of March. So about a 5 or 6 week period, the market was down well over 10%, well, close to 10%. So we actually had almost a correction middle of this year. But what's happened since that trough point, the market just really taken off. So a large part of the reason why the market had that sell-off was it was largely related to oil energy prices. Oil prices skyrocketed. They went from beginning of the year, we were at mid 50s, but beginning of March, I think they're around this kind of low 70s, high 60s, and they actually hit $120 a barrel at one point. Now oil is trading right around $73, $74 a barrel again. But so we had this energy shock, we had oil prices skyrocket. And so we got to this point here, the market really sold off. But that was an interesting time because that was also before Q1 earnings started happening. So right around that point, stocks started reporting earnings for Q1. So it coincided with two things. The stock market was starting to get pretty cheap. When we look at valuations, price earnings multiples, the stock market was getting a lot cheaper at that point. And then companies reported earnings. And not only did they impress, they hit it out of the park. So we were expecting earnings growth to be 13% year over year. For Q1, they came out in about 26%. So they doubled estimates. So it was a really good scenario there. We had multiples and valuations come down and earnings beat out the water. And at the end of the day, what drives the stock market? It is earnings. It always comes down to earnings. How are companies? Well, just earnings of companies. Of course, we're talking about S&P in general, but it's the companies that comprise the S&P 500 in this example. Yep. So overall, again, we're sitting at a nice spot right now. That's not to say we've had some uncertainty, and not to say there's going to be more uncertainty and volatility ahead. That's just a normal part of it. But so far, we're at a nice point. Looking at the Dow Jones anymore, I don't pay a whole lot of attention to it. It's somewhat of an irrelevant stock market index because it's comprised of 30 stocks. It's price weighted, which isn't going to mean a lot to most of you, but it just means that it's more dependent on the price of a stock, which the price of a stock makes no difference. It's the market cap or how big of a company that makes a difference in my mind and most people's minds as far as how much weight we're going to put into it. But anyway, a lot of people pay attention to it. It's been around for the longest. It's the longest index that we have. And it's sitting as of yesterday at 51,000, called 700. So we crossed that psychological barrier of 50,000 earlier this year. A couple weeks later, we had that sell-off, but then it's really rallied as well too. So the Dow is up to almost 52. And then the NASDAQ is an index that's comprised primarily or more heavily of technology stocks. So it's going to be a little bit riskier index than the previous two. There's a lot of companies that are registered on the NASDAQ. But anyway, you're going to see more often than not when the stock market sells off, you're going to see larger drawdowns in the NASDAQ. When it recovers, you're going to see much quicker gains, acceleration. So the same was true here. When I said the S&P was down almost 10%, the NASDAQ was down 14 or 15% at the bottom. But now the NASDAQ actually year to date, as of yesterday, was up about 13, 14%. So all in all, it had a nice recovery too from that bottom point. Literally since basically beginning of April, end of March, beginning of April, the market just really took off. It just kind of was a straight line. So that's where we're sitting here today. Getting more into the economic side. So consumers are still feeling higher prices. Going back to 2020 during COVID, we had kind of the perfect storm for inflation. We had the economy shut down. I'm not going to steal too much of Tim's thunder, but we had the economy shut down. We had the federal government flooding a lot of money into the system, empty money supply, which in our opinion, a lot of our economists that we like his opinion, is one of the biggest drivers of inflation. Empty money supply shot up by 40%. We've not seen that ever. So there was the perfect storm for inflation. We saw it start to really peak up in 2021. They were all saying it's transitory. But anyway, in 2022, we saw inflation peak at 9.2%. So that's inflation we've not seen since the 80s. Since then, of course, the stock market sold off in 2022. It was a bad year. But since then, we've still been dealing with that inflation issue. It has certainly come down. It's been much, much more tampered, but it's still not close to the Fed target. The Federal Reserve has a target inflation rate of 2%. Right now in June, the CPI, which is what most of us look at for inflation, it's called the headline inflation number. There's a lot of numbers we pay attention to, but that's the one a lot of people pay attention to. Came in at 4.2%. Previously, we were seeing readings in the mid threes. We had a big increase it was in June, but for May's reading, because guess why? Because oil prices skyrocketed. The May reading, 60% of the increase was just from oil price increases. So to us, that's somewhat of a transitory in nature. The rest of CPI was pretty tampered, actually. Or when we look at what's called core inflation, we strip out energy and food. So it's things that are more, food and energy are always the most volatile. We're going to see a lot of price fluctuation. But when we look at core inflation, it's still just kind of been sitting there right around 3%. So we're really anxious to see what June and July's inflation report is going to look like, because that core has been really kind of stable, moderate to stable. And when energy prices come down, which we already have seen, that oil again is at $73 a barrel, we're going to see headline inflation really come down as well too. So overall, it is certainly moving in the right direction. It's still been pesky. It's not below the Federal Reserve's target of 2%, and we're probably not going to get there for a little while, but it's certainly sticking around. And one of the things that Tim talks a lot about is that when we look at inflation, that's your year-over-year increase. So when you have a year where we were up to 9% inflation, then it was maybe 5%, then 4%, now 3%. These are all compounding, right? So if you go back to 2020 versus what prices look like now, you're looking at some significant jumps. I mean, talk about going to the grocery store. If you have a receipt from 2020, what that looks like compared to going to now, 25, 26, you're probably looking at significant increases in prices. So we rarely see a lot of that come back of what's called deflation. We rarely see deflation in the economy. Certainly parts of the economy or parts of the goods and services sector we do, but in general, prices tend to go up. But we're hoping to see that get back to the 2.5, I think would be a much better place to be. So certainly the lower inflation too has helped the equity market. What coincides with higher inflation is higher interest rates, and that's certainly what the Federal Reserve did in 2022. Interest rates skyrocketed, got up to 5.5%. What the Fed funds rate got up to 5.5%, and then here we are today. The Fed funds rate is sitting a little bit lower, but when the Federal Reserve has to raise interest rates and inflation's high, people don't have enough or much money left over in their pocket. The stock market doesn't like that as well too. So since we've had some of those things switch, the market has certainly appeased that or like that. Talking about interest rate uncertainty, going into the year, it was of the prediction markets, or the stock market was almost predicting or betting that we're going to have 2 rate cuts going into this year. Here we're halfway through the year. We've not had any rate cuts. It's just been flat. We just had our first Federal Reserve meeting with the new Fed chair, Kevin Warsh. So no change. There was certainly some change in language from what previous Fed chair Jerome Powell spoke to, but they actually forecasted 6 of the Fed Fund chairmen anticipated no rate cuts the rest of the year. 5 of the 12 anticipated one rate hike and one anticipated one rate cut. So we're kind of at this standstill right now. There's not a lot of consensus on the Federal Reserve Board, but the current Fed funds rate is sitting at 3.5 to 3.75%. We've had some somewhat conflicting economic data, but for the most part, we've had some strong economic numbers that have come out. The inflation has been persistent. It's not really come down like the trend at one point was showing. So that has presented a unique opportunity, a unique challenge for the Federal Reserve. So more than likely, it's probably of our opinion that we'll see interest rates kind of stay stagnant. Maybe see one rate cut. At this point, I think it's too early to say, but probably not going to be a whole lot of change.
Yeah, a lot of it's really probably data driven too. If inflation would rear its ugly head again and actually go up over the next few months, then that increases the odds for an interest rate hike increase. If inflation tames or goes down, then it will increase the likelihood that interest rates will stay the same or possibly go down. Now, there is an economist from Bank of America yesterday. He predicted 3 interest rate hikes by year end. So when Max said there's not a consensus, there's not a consensus. They're all over the board on that.
Yeah. One thing that economists sometimes will pay attention to a lot, but economists particularly, is this consumer sentiment. So the University of Michigan has the main one that people follow. It's a consumer sentiment survey. So they've been doing this, I think, for well over 20 years, dating back to the early 2000s. And what it is just it's a poll, a survey to people all across the United States. It's just about how do you feel about the economy? And I think there's a number of different questions that they do this monthly. So the University of Michigan comes out with this, and it's on a scale of kind of 1 to 99. So in June, the consumer sentiment survey came in at a 48.9, which is 40% lower than the average trend historically. So that's very low. In May, the sentiment survey came in at 44.8, which was an all-time low. An all-time low. Even we went through the Great Recession, 07, 08. The economy, the markets were horrible. And at that time, I think the reading was still in the 60s. So the way consumers feel today is an all-time low dating back to the time of this survey. But what's interesting is that we have this tale of what people think or feel versus what their wallets are actually doing or what their spending habits are actually doing. The spending numbers are strong. Consumer demand and spending is continue to grow, but the way people feel about the market or the economy is a whole different way. So,
I mean, even pay attention where you go. I mean, I was in Des Moines over the weekend. The highways are full. We were in a restaurant. The restaurant was full.
Yeah, I've been traveling lately. The airport is full. I mean, in fact, the airport TSA screenings are the highest they've ever been. They're higher finally now than they were pre-COVID. First time they just crossed that not too long ago. So
you probably notice the same when you're out and about. So the consumer is still strong.
Yep. So there's probably a lot of different reasons why people feel a certain way. Of course, inflation is just one of those things that ultimately it's a tax on the consumer, and we've all felt it. But it's that compounding effect, especially of the inflation. When we go from 9 to 6 to 5 to 4 to 3, we're still dealing with much higher prices, dating back for 4 or 5 years ago. So artificial intelligence. This has been one of the biggest trends, I think, for at least the last 3 or 4 years in the stock market. We're all hearing more and more about it, how it's going to affect our lives, and certainly how it's affecting companies in the stock market. And it's going to continue to be that way, at least for the foreseeable future. I don't think it's not going anywhere. There's a lot of money going to this field. So many companies they're viewing this as a way to increase productivity, increase efficiency, be able to analyze big data, make decisions at a high level in a much quicker pace. And so in 2026, we call them somewhat the hyperscalers, but Amazon, Meta is Facebook, Google, and and Microsoft are spending, those 4 companies alone are spending $725 billion in 2025 or 2026 alone on AI CapEx spending. $725 billion amongst 4 companies. You add in companies like Oracle. I'm missing some, but there's companies out there spending so much money because they feel like spending this money now is going to affect their future revenue, their future bottom line, their net income. So there's a lot of reasons why, and we're already starting to see that productivity increase. With that, these companies, a lot of these technology or AI companies have seen some really nice rallies in the market, and now they're quite a bit of the overall index. So we're say technology concentration has gotten increased. So in the S&P 500, for example, the top 10 names of the S&P 500 make up 40% of the index. So 10 stocks comprise of 40% of a 500 stock index. The other 490 comprise of the other 60%, obviously. So we've seen it get really concentrated, really tech heavy. And what do we know about technology? Well, those stocks tend to be a little bit riskier. About a third to 40% of the S&P 500 is AI themed investments. So they're not directly, a chip maker necessarily, but they're involved one way or another in artificial intelligence. So we're seeing a lot more concentration. But one of the things that Tim and I continue to talk about with all of our clients is that it is going to continue to be a market dominant theme, but there's a lot of opportunities that present itself with artificial intelligence. I brought up the example of when we had the gold rush. Everybody thought, okay, we got to be invested in the mines, the mining companies to make the money. But what if you invested in the picks and shovels? So no different today. There's a lot of money going into like NVIDIA. That's one of the names that it's the biggest company in the world now. It's the biggest chip company. And that's where a lot of companies are putting their dollars, and investors. And it's certainly a great name to be in, and it has been a great name to be in. But there's other opportunities out there. You think of the companies that are building out the data centers, companies building out the grid, the utility companies, the cloud computing companies, the cybersecurity companies. There's so many opportunities to make money when there's $725 billion being spent by 4 companies alone, and you add on the rest of the companies in the S&P and et cetera and elsewhere that are spending this money. There's a lot of money to go around. It's trying to find other opportunities to make it work. So certainly the large cap technology names are gonna, we think, probably continue to perform well. But it's again, one of the things we call it build it, power it, protect it. So it's buying the companies that are building the AI infrastructure, the data centers, power it, buying the companies that are building out the grid infrastructure. We have this huge demand for energy. Our grid is certainly not there yet. So with consumer demand and now with AI's increased energy demand, we have a huge demand for grid capacity, but we are certainly not there to get it. So we're buying the companies that are companies in investments that are building out the grid, and then protect it. What do we have to do? We have to protect the infrastructure, the software that's there. Cybersecurity comes into place at that point too. So a lot of different ways to play the AI theme, which we feel is not going anywhere anytime soon. So the labor market is cooling, but it's still really healthy. So hiring demand has slowed closer now to historical averages. I'm going to go back here. So our current unemployment rate is sitting at 4.3%. Historically, that's a very low unemployment rate. I think at one point we were in the low to mid threes. We've ticked up a little bit, but 4.2% is still historically pretty low. In May, we had 172,000 jobs added to the economy. So that shattered estimates in May. Over the years, the last 2 or 3 years, there's certainly been a lot of revisions up or down. So we always have to take that with a grain of salt, but still a pretty staggering number in May. And we still have 7.6 million job openings, believe it or not, here in the United States. So the way I kind of describe the job market right now is it's a slow hire, slow fire market. A couple years ago, I think it was an employees market where people were leaving jobs. There was plenty of jobs out there. You might leave a job and have 4 other opportunities, but now it's not the case. It's much more specific industry driven. And in certain industries, we're seeing technology companies actually lay off a lot of employees, but there's also a lot of hirings in the and some of the what am I saying? Construction space, industrial space. So certain people are laying off, certain are needing more employees, but still at a very healthy spot. So what am I missing there? If we do see unemployment start to tick up over 5.5, that would obviously not be a good sign for the economy. We'd start to see things start to slow down, but still where we're sitting now, all in all, pretty good. So
Anybody remember back in the 80s, they called it stagflation, or they had the misery index? The misery index was inflation rate plus the unemployment rate. And the higher that would be, it would be more miserable. So if you had inflation at 5% and you had an employment rate at 5%, that'd give you a misery index of 10%. So if we have historical standards of 2% inflation and 4% unemployment, then your misery index is at 6, and that's a good, healthy economy. So, and if you remember back in the early 80s, I know some of you do, stagflation, where you had high inflation and high unemployment. And they called that stagflation. And usually they work opposite of one another. When unemployment is high, inflation is low, and vice versa, generally.
and it makes sense. With unemployment's high, people aren't spending money. So when people aren't spending money, inflation tends to be tampered. So
I like to use my thumbs. It's an inverse relationship. When unemployment is low and a lot of people are working, then that would make inflation high, and vice versa. Now, productivity over the last several years and the use of computers inside business have changed that a lot, because you can have very low unemployment without inflation anymore. That's what I believe, just because of computers and productivity and the predictability of what your markets are going to be. So anyway, not like it was back in the 70s and 80s. Much, much different right now.
as always, we live in a global economy, global markets. I brought up the example, even as of this morning, the South Korean stock market sold off 10% last night, which caused the US stock market to start to sell off this morning. And that's why, in large part, why we ended up, the NASDAQ was down over 2% this morning, because we've seen, when certain companies like Samsung and SK Hynix, which none of you probably even, well, Samsung, yes, but SK Hynix have had some massive run-ups. They had this massive drawdown. It's just spooking a little bit. We call it mean reversion, which Tim will talk about here in a little bit. But we saw this sell off a little bit today here in the US space. So we live in a global economy. US-based businesses are doing work all across the world. It's no longer, strictly here in the United States, and even foreign companies we see do a lot of business here as well too. And with that, when conflicts arise, we're going to see some volatility. So certainly the last couple of years, really always there's going to be something going on worldwide that can move markets, and in the short term it definitely does. So as a recent, fresh in our minds, the Iran conflict, we got Iran and the United States. What does that happen? Well, oil has skyrocketed again. Since then it's come down, but that's certainly been a market mover. Trade policy, going back to last year when the Liberation Day tariffs were announced, the stock market sold off very rapidly, 2 days back to back down 5%. And then we had a little bit of a pause. The market rallied, but we certainly saw a sell-off there. Energy market, supply chain security, supply chain disruption, COVID. So there's always events that are affecting the economy, affecting the stock markets. But one of the things that we oftentimes talk about is that even just as a here recent, the stock market sold off because it just anticipated businesses and consumers to slow down. But we've really not seen that actually flow through the data whatsoever. But in the short run, these global events tend to see a sell-off. But it always comes down to, is it going to affect the bottom line? Is it going to affect earnings? This recent example, no. And even going back to like tariffs, the tariffs for most businesses, never had the impact that a lot of doomsayers thought it would, because we talk about it, businesses tend to be resilient. These are some of the most innovative companies in the world, and they tend to find a way to get through. So it's usually the uncertainty that can cause disruptions and cause issues. But once businesses and companies know what they're dealing with, they can find a way to innovate and get through. And so that tends to be the case year over year, where they just find a way. But so it's certainly going to affect our markets, all these events, but it oftentimes can be short-lived. Not always, but oftentimes. Looking just at long-term trends of the market, so 1, 3, 5, and 10 year, just we like to say long-term, obviously month to month, day to day, month to month, even year to year, we don't know what's going to happen. But the longer we have for a time horizon, the longer we can have our funds invested, money invested, your odds of success are going to go up and up and up. So over the last 1 year, the Dow, this is as of last Thursday's close, the Dow is up 22%, S&P 25, NASDAQ 25, doing a 5-year annualized return, Dow 9, S&P 12.5, NASDAQ 13.5. You go back to a 10-year, the last 10 years, Dow up 11%, S&P 13, and NASDAQ 18.6%. Again, that's an annualized return. So if you just invested blindly in the NASDAQ index year over year of the last 10 years, didn't sell out to fluctuations, you would be up 18% annualized. So pretty incredible. We've had a really nice run in the stock market. Short-term returns are going to vary widely, as we all know. You look at your account every day, you're going to see some big swings up or down. If you look at it a year down the line, 5 years down the line from now, more than likely we're going to see some success. So long-term returns tend to be consistently positive. About 3/4 of the years, we see positive returns in the stock market. And when they're positive, they tend to be up nicely. 1/4 of the time, we tend to see a decrease in the stock market. So pretty good batting average. And the longer you have out, the better off you're going to be. The longer you stay invested, the more predictable outcomes become. Volatility is normal. Oftentimes we get caught up in volatility and think the stock market maybe is too risky, or volatility is a bad thing. Volatility is simply, it's the changes of price. So when you see price fluctuations like this, we're in a really volatile market, but sometimes it can be a little bit more smooth. And we measure that with a thing called the VIX, the volatility index. So volatility, we say, is it's the price of admission for long-term growth. If there was no volatility, everybody would put in their money in blindly, and we'd have no risk, and there would be no markets, and it wouldn't be an efficient market, obviously. The markets do not move in a straight line. It's a roller coaster, but again, it's that price for admission for long-term price appreciation. And not only does that, is that the stock market, that applies to a lot of different examples in our lives. So corrections happen fairly regularly. In fact, about every 18 months, 1 to 2 years, we're seeing a correction in the stock market. So that's a drawdown of a peak to trough of 10%. Bear markets, where we see it drop 20% peak to trough. That happens, maybe it's like every 3 or 4 years, but it does happen. But even like now, the stock market's had this really strong run up, and Tim's going to talk about it, but it's common. It's okay for the market to just pull back a little bit. That's a healthy thing. You don't want to see this euphoric market where people are, borrowing money, buying indexes on leverage. So it's a feature, not a flaw. And what moves the market? It always comes down to earnings per share. All those other points below, economic data, interest rates, inflation, they all move the markets, and certainly in the short run, but they move the markets if it's anticipated it's going to have an effect on earnings per share. So earnings continue to drive the story. And catalysts as well too, especially in the short run. We all know that the pandemic was huge. The market was down 35% in just 6 weeks. After that, it really shot back up. Tariff policy had a huge impact on the market over a week period. Since then, we've seen the market take off again. The Iran war, 07, 08, 09, we saw a 54% decline in the S&P 500, so a horrible time to be invested for folks. But so those are significant catalysts. Inflation was another good example. More recent in 2022, the market was down 20%. So there's going to be catalysts, but those catalysts tend to affect that top bullet point, earnings per share. So I don't need to hit on too much. It's just said it all before. There's going to be challenges and opportunities all the time in the market. It's always going to come down to corporate earnings. Innovation, productivity, those are things that can increase earnings. Strong unemployment, economic expansion, positive things for corporate earnings, and positive things for the market. The stock market is always a future indicator. It's a future predictor, looking at 6 to 12 months down the road. So when a stock predicts or announces earnings, we're looking at what is their forward guidance? What are you anticipating to make in a year from now? And that's a lot of times how a stock gets valued.
You go back to that last screen, Max. I want to point out the statement that you put in there, and it's time in the market versus timing of the market. And we tell people over and over again, it's like, we don't have a crystal ball. We don't have the magic 8 ball. I have no idea what the market is going to do tomorrow. Nobody does, not even Warren Buffett. So we are telling people it's time in the market, letting your investments sit and ride instead of trying to guess what the market is going to do from day to day. So as Max said before, a lot of times the best days in the market follow one of the worst days in the market. So If somebody panicked on a bad day in the market and said, "Oh, get out, I need to sell everything before I lose everything," and then the very next day the market goes shooting up. That is emotional investing, and that's what we don't want to do. So our next few slides, what we want to do is maybe talk about some economic terms that you may hear in the news. You may talk about, you may even hear us say it. And so we want to go over some of these economic terms that are relevant today. And the first one I want to talk about is mean reversion. Now, I'm going to take you back to your statistics class or algebra when you learn mean, median, and mode. Does anybody remember those from high school? Yeah. So, and I don't know why we call it mean reversion. Mean just simply means average. We return to the average. Mean reversions means reverting back to the averages. Now, median, if you have a series of numbers, it's the middle point. If you have a series of 100 numbers, it's whatever is in the middle, that is your median. And the mode is the most reoccurring number in a series of numbers. So for an example, if you wanted to say, well, what's the average? What's the mode temperature in the 92 days of summer? Whatever temperature, high temperature appeared the most, that would be your mode. So as an example, I'm not sure really what the significance is of the mode. I've wondered that many times myself. So, but I suppose if you're dealing with temperature in summer, but anyway, the market, we always say when the market gets overpriced or underpriced that it's going to revert back to the mean. So I have an example up here, and this is just a chart. This gray area is called a Bollinger Band. For those that remember statistics, it's two standard deviation points either way from the moving average. Don't ask me to explain that to you right now. The moving average is the middle black line that goes through the gray line. And you can see that is a 20-day moving average, I believe is what we have. And then the standard deviation points are above and below. So the blue line, if you could all make that out, the blue line is the jagged one. And where, Max made a point earlier, it never just goes straight line up. It goes up and it goes down. But at any point, when we're looking at the standard deviation, the market will sometimes oversell, like where my finger is right now, and it's trading lower. It's trading even below 2 standard deviation points. So when we would get here, we'd say, this is a pretty good time to buy, not exclusively. I tell people, don't look at this chart and think this is a surefire buy or sell signal, but it surely is one of them that we would take a look at. So if we get right down here, we'd say, well, this is a pretty good time to buy. Now, if we were here and we couldn't see the rest of the graph, we wouldn't know how it turns out. So we don't know for sure. But as I say that and you look at this, yep, it was a pretty good time to buy because you see how the price of the market shot up. And again, right here as well. This was right when the Iran war conflict started, and it took the market down in late March and early April, and we hit bottom. And you can look at that as a pretty good time to buy. Now let's look at the other side. We've had a run up. Now we're trading above the 20-day moving average. And when we get clear up there, we would say, well, at some point, maybe it has to pull back a little bit. Well, let's say that you looked at this one. See this point over here, right there? Now, if you would have looked at this graph alone without any other graphs or without any other information, you would have said, boy, I better sell right now. And look what you would have missed out on. So we went through several weeks where the market traded above its moving average. So, but eventually it will revert back to the mean. You see, as we went a few weeks down at that point right there, it started coming back down to the average. So it's mean reversion. Everything reverts back to the averages. And why we say this is that over my years of doing this, 28 years, people will come into my office and say, well, don't you think the market has to crash? And I'm like, what do you mean by crash? You mean crash like 1929 or crash like black, whatever day it was in 1987 where we lost 25% in one day in 87? Or does it crash like you mean in 07, 08, or 09 where we went down 54% over 17 months? Is that what you mean? And I don't think that's what people mean. I just think they mean prices have got too high and we have mean reversion. We have a small, I'm not even going to say correction, but it's just the market pulls back like 3 or 4 or 5%, 6 or 7%. And it's just healthy. It's just what the market does. Or if the market gets too cheap, people will start coming in and buying and send that right back up. So that's all it is mean reversion, returning back to the averages. Now, a question for you. Do prices have to come down or go up to revert to the mean. Well, remember how many days I said this black line was? It's a 20-day moving average. What if we have 20 days where the prices just do this? They don't move, they don't go up and down, they just stay steady. Well, sooner or later, just because it's a 20-day moving average, it will revert to the mean just because prices became stable. So doesn't always mean there's a big shift one way or another. Now this makes it almost look like that, but if you look through this period here from December through March, it was a pretty flat market. We didn't have any significant gains from the beginning to the end. You see what I'm pointing at? This is December right here. And we go out to March and it looks like it's about the same beginning and ending price were about the same. Now you had fluctuations in between there, but in that time period is about the same. Mean reversion. If you watch any business news, especially during volatile times, you will hear them talking about this. And by the way, this is not just the stock market. Anybody who farms corn, beans, gold, silver, oil, pork bellies, cotton, you name it, if it's a commodity or something that has daily price adjustments, reverting to the mean is a very common thing no matter what we're talking about. Make sense? Okay. Anybody have any questions about mean reversion? So next time you hear me say mean reversion, you'll know he's just talking about reverting to the averages. Okay, why does mean reversion matter? Well, it takes the emotional decisions out of long-term investing. If if the market goes up, and a lot of times people say, "Oh, my stocks are up," they're feeling like they have the Midas touch, that everything they do turns to gold. We always say, be careful because that's emotional investing. We want to take the emotions out and we want to try to invest logically and rationally. Likewise, when the market goes down, every once in a while, we'll have people get fearful and they'll want to sell out. Now, what are you supposed to do when the market goes down? Buy. Everybody knows to buy low and sell high. Yet sometimes people's emotions cause them to do just the opposite. Alan Greenspan just passed away a couple of days ago at 100 years old. He was the one who coined the term irrational exuberance back in the 90s. When things right before the dot-com bubble, when things got really, really expensive in 99, I think it was, he said, yeah, it doesn't make any sense and it's irrational exuberance. Chasing performance, the fear of missing out, we call it FOMO. A lot of that happens like a couple of weeks ago, SpaceX went public, had their IPO, stock went from $150 to $225 in a matter of a couple of days. Was it this morning it traded down at 147? So it actually traded down below its initial public offering, and then it just shot right back. Well, not shot back up, but it was 159 or 160. It ended up positive today. So anyway, selling during downturns, we just mentioned that, the fear of losing more money when you should probably be buying versus selling. And trying to time the markets is just hard to do. We're in this every day, and honestly, we don't time the markets. It's just very, very difficult to do.
I just had a client yesterday ask me if I day trade, and I'm like, well, no, not only do I not have time for that, but when you look at the data, 10% of day traders actually are profitable. 90% of people who are trading daily are losing money on their investments. So yeah, I know the odds, if you just stick to your goals, if you just continue investing, your odds are pretty good, right? So day trading is never been a good trading strategy long term.
And day traders usually doing it themselves. And this is not us. This is other studies going. It says people who try to do it themselves and time the market and jump in and out, their average long-term return is 2%. Versus what Max just showed you a little bit ago, that's 12, 13, 14, 18%, so.
And ignoring diversification, this one can be hard too. We've seen over the last 3-4 years, large cap technology primarily really driving the market forward. I mean, it's been that way for quite a while now. But it is important to stay diversified. I brought up this example this morning, but in 1999, Tim said he had a new client who he did about half in, say, large cap growth, half in large cap value. Well, at that time, anything large cap growth or anything technology names just was skyrocketing during that dot-com period. Well, then what happened a year later? And so she actually came in and said, well, why am I invested in large cap value when this has done so well?
She literally had 2 pieces of paper and say, why am I invested in this one when this one is doing so well? This one was flat for the year, did 0. This one is up like 50%. This is a true story. And this was in January of 2000
Yep.
after a great year in 1999 of the dot-com and technology driving things up. Go ahead.
So she actually left Tim, but a year later, what happened? The dot-com bubble busted and large cap growth or just technology names plummeted, and value actually had really good years there in that early 2000 period. So it's just important to stay invested. We never know what's going to happen. We can have years and years of technology riding the way, but it's still important to have some money over here when this goes down. We want some investments in the other side that are going to continue to prop up. Hopefully that's how it should work. Not always the case, but
A lot of times, then it goes to sectors. Last year's winners are this year's losers. Last year's losers are this year's winners. It happens over and over. There's a rotation in the economy, especially when it comes to sectors. Maybe not so much individual stocks, because there's some individual stocks that just keep on keeping on. But when sectors, a lot of times, let's say that you had gold and silver do really well one year, maybe they do really poorly. Maybe they're at the bottom the next year, and pick whatever sector you want. There's just a certain rotation that goes on frequently. So very important to diversify. Inflation and interest rates, what is it? Where does it come from? So you all know that inflation is generally the rise of the prices over time. And as Max said earlier, the long-term goal of the Federal Reserve is to have about a 2% inflation rate. We have times where it's just much, much higher than that. And there's even times where it's been hard to get a 2% inflation rate, where we've had a little bit of deflation as well. The rate of inflation has improved, meaning it has gone down from the 9% that we had in 2021, and then it was 6 point something percent in 20, or is it 29% in 22, 6% in 23, and then, as Max said before, it's hovering right around that 4%, dropping from 3 back up to 4. So, and it has an effect on pretty much everything that you do. So, let's go on to the next one. So let's just talk about how inflation happens. And I'm going to give you the example and going back to COVID in 2020. But first of all, let's talk about demand pull inflation. This is too much demand chasing too few goods. So this is the kind of inflation that you would have at an auction. Let's pretend that this Journey Financial Cup was for sale and it was a one of a kind, and you're at an auction and it's the only one for sale and a bunch of people want it. What's going to happen to the price of that? It's going to get bid up. Now let's pretend I have 30 of these and I go into a place and we're going to try to sell all 30 of them. We're going to sell them one at a time. What are you all going to do as bidders? You're going to sit on your hands. You're going to wait for the price to go down. So demand pull inflation is to give you an example, is like an auction. It's when there's too much demand chasing too few goods. Think about what happened when COVID went on. What did our federal government do to our economy? They shut it down. Could you go to homemakers? Nope. Could you go buy a car? Nope. You couldn't really pretty much go anywhere. They had Target and Walmart because they supposedly had the essentials opened up. But I remember going to homemakers and buying a piece of furniture a couple of weeks after it opened back up. And they just said, oh, we're just so busy because everybody wants to buy now. So you couldn't go spend your money. So what did you do with your money? You saved it. What else went on at that time? What was the federal government doing, especially for young families? Yeah, they were giving money away left and right. Fog a mirror, we'll give you a loan that you don't have to pay back. Crazy things like that were going on. And a lot of people took advantage of this, and their bank accounts swelled. You mentioned M2 money supply. M2 money supply is the supply of money, and it's the sum total of all checking, savings, and money market accounts in the entire United States. So they actually keep track of that. And what happened in those days is that M2 money supply, the sum total of everybody's checking, savings, and money markets just grew to trillions and trillions of dollars. And people had no place to spend it until they opened up the market. And then as soon as they opened up the markets, they opened up the economy. This is where we had demand pull inflation. Too much money chasing too few goods. This is the monetary factor that just goes along. These two just go hand in hand overall. Too much money chasing too few goods. Back when I taught economics in the 1980s, that's what I taught inflation. It's too much money chasing too few goods. It was the perfect storm for inflation to happen in 2022. And it was created by our government.
Well, governments worldwide, but our government in particular here.
All of them, yeah. But our government in particular, handing out cash.
The supply shortage, or you touch on that. You mean
of goods?
Yeah.
Yeah. Yeah.
the supply chain shut down at that time too. So even the goods weren't getting over here to even sell. So
Yeah.
that also
You couldn't do
coincided
it.
with
They're
the
sitting
thing.
on boats in the harbors and out in the ocean, and they couldn't even get unloaded at the docks. So, yeah, so you had all that built up money, not enough goods to buy, and they caused it. Now, yeah, I guess I won't get into the politicians, but yeah, they caused it. They caused it. The other type of inflation happens, it's called cost push inflation. And that is when the cost of making a good, a product, let's call it a widget, just happens to go up. There's all sorts of costs that can go into it. It could be the raw materials. It could be energy costs like oil. It could be wage costs, wage increases. Um, yeah. Um, I won't get into that one. I'm sorry. I got you all excited about this, and I really can't say it, but it's when maybe a certain business all of a sudden starts bragging about paying their people X number of dollars, and I'm sitting here thinking, why are you bragging about this? This is just ignorance gone to seed. It's why are you saying we're going to pay all of our people, 15, 18, $20 an hour when that job is really worth 10 or $12 an hour? I don't get it. But anyway, when you have wage costs that go up, you have to increase the price of your goods to make up for your wages. When you have raw material prices go up, you have to increase the price of your goods to make up for those increased costs of what's going in. One of the most common ones that we'll see when oil prices go up or fuel costs go up. And the grocery stores will tell me about this, is that they will get a truck coming in and there will be a fuel surcharge on there. Has anybody in business ever experienced that before? A fuel surcharge. It's like, oh, where did this come from? Well, it costs us more money to ship these products to you, so we're passing that on to you. Well, what does that force a business to do? You have to turn around and charge more because you have to cover your costs. So anyway,
Yep.
yeah, enough there.
Go ahead, Fred.
Yeah,
On
go back.
one process of bringing jobs back from China. A lot of those jobs left to go over there because they can force labor or cheap labor to create a product.
I'm going to use the example of NAFTA, the North America Free Trade Agreement. So what did they do with NAFTA? And I was always a free trader until I wasn't. And here's the way out is, well, NAFTA is good because NAFTA, what it allowed companies in the United States to do was move their operations, their factories down to Mexico. And what was the price of labor down in Mexico? Was it the same as the United States? No, it was cheap, maybe $4 an hour. Then that's exactly right. And so what about OSHA? Did OSHA exist in Mexico? Is there a Department of Labor? Is there a minimum wage? Is there a requirement to provide health insurance? All these regulations in the United States that they put on businesses and factories, and then all of a sudden they look at the businesses in the United States and say, oh, we're going to let you move to Mexico. And guess what? We're not going to make you pay a tariff when you bring your goods back into the United States. Now, the rest of us loved it because what did it mean for us? It meant cheap goods. But in the long run, I think it hurt the American worker. It hurt the American factories. Yes, it was good because it kept inflation down to a certain degree and made cheap goods for us. But I remember the politicians would get so mad at these companies for moving their factories down to Mexico. And I thought to myself, well, wait a minute, you passed the law. What did you think they were going to do? You said they don't have to pay tariffs anymore. And so why wouldn't you, if you were a factory, why wouldn't you move to Mexico to build your product and bring it back to the United States? We faced it right here in Jefferson, Iowa with Electrolux. Frigidaire, it was Electrolux that went down. Maytag did the same thing down in Newton. They moved their operations because they can make their product cheaper down there. So anyway, yeah. So yeah, again, don't get me going on politicians, but when the politicians are pointing the finger at the businesses and calling them mean, greedy, money hungry people, it's like, no, wait a minute. You passed the law. They behaved precisely the way you knew they would. So don't point fingers and call them greedy, money hungry. That's my opinion.
My question is, how is that considered inflationary?
Now, so this is interesting because I was sitting in Rotary Club when they first started talking about this, and I said, just don't assume that tariffs are going to cause inflation. And the person looked at me like, well, and tariffs always cause inflation. No, because here's the difference between demand pull inflation and cost push inflation. Over here, the consumer is causing this. Over here, it's the manufacturers that are raising prices. Does the consumer have to accept this? No, they don't have to. They can say, I'm not paying that price. And what they'll do is they'll go substitute for something else. Classic example, back in 2020, we closed down the economy and you couldn't get on an airplane to go anywhere. So what did people do for vacations? The demand for campers and boats went through the roof in 2020. They substituted. I can't do my European vacation. I can't do my cruise. So I'm going to go buy a camper, and that's what I'm going to do vacation wise. What do you do if beef gets too expensive? You eat chicken. You eat pork. You substitute. This is another economic term we actually teach. It's called the substitution effect. When one product gets too high, then you will substitute it for something else. Going along with that is what we call the complementary effect. If there is a great demand for a product, then you will complement something else. So let's pretend that there's a huge demand for new cars. Well, what's going to happen to the demand of tires? Well, let's say that there's a huge demand for beef. Well, it's going to get complemented along with ketchup and mustard, or steak sauce, things like that. Substitution effect, when you substitute goods for something else. Complement effect, when something is really, really hot, what else gets pulled along with it? Max used the great example of the gold miners. What was the complement to the gold? Picks and shovels. 2 ways to get rich with that gold rush. So, and those are opportunities that exist in economies day in and day out. Constantly those types of things and opportunities we can be investing in. So, does anybody have any questions about inflation? What causes it? I certainly think some inflation is worse than others. I think that demand pull inflation is a really, really stubborn inflation to get over. Cost push inflation, not so much. I mean, it's still not good, but the consumer does not have to agree to that. So unless they, maybe absolutely have to. So interest rates, the cost of borrowing money. How does interest rates affect to inflation? Well, we're going to introduce another couple economic concept, easy money policy and tight money policy. When the Federal Reserve wants to stimulate the economy, they will lower interest rates. That's what we call easy money. And they have other ways to do this, but as far as interest rates go, that's what they'll do. They'll lower interest rates to stimulate the economy. Why? They want people to borrow money, to buy that house, to buy that car, to start that business, to remodel a house, do whatever you want. They will lower interest rates to get it going. Likewise, when inflation is stubborn and they want to say, hey, we really need to cool this economy off, they will raise interest rates to stop people from spending money. And so when interest rates are high, I mean, okay, Amy, what is the demand for mortgages right now compared to what they were 4 years ago when you can get a mortgage rate for 2.5%, 2.75%? But much lower. I mean, back in those days, how many mortgages were you writing every month? Refinance it, you bet. Over and over again. You were so busy, you probably couldn't keep up. Now that mortgage rates are what, 6.75%? Give or take a little bit. And has that slowed the mortgage market down? Exactly. So the Federal Reserve will raise interest rates just to slow the economy down, to keep people from borrowing money and spending money and the ultimate purpose is to try to drive inflation down. That's why back when we had the big inflation rates in 2022, that they raised interest rates so aggressively, because they had to slow inflation down. So that's easy money and tight money. This is what we call monetary policy. Whenever we're dealing with the Federal Reserve, it's monetary policy. Whenever you're dealing with taxation and what the government and your congressman will do, that's called fiscal policy. So if our congressmen felt like they wanted to stimulate the economy, then they would decrease taxes fiscally. Fiscal policy would be decreasing your tax rates, put more money in your pocket so that you'll spend more. And then what that does is we call it the velocity of money. It's how many times can you get that dollar turning over in the economy? If you can get that dollar turning over 6 or 7 times, that is really going to help that economic growth engine move. But if you got the dollar only turning over 4 times a year, that's just a really, really slow velocity of money, and it doesn't get that dollar being spent over and over again. So Ironically, and again, we can go back and prove this. You can actually decrease the tax rates. And if you could increase the velocity of money, you will increase tax revenues. You want me to say that again? You can decrease the tax rates, so your rates on the amount of income can go down, but yet the government could end up collecting more tax revenue if they get that dollar turning over in the economy over and over again. It's called the velocity of money. It was proven in the 1980s when they first did this. The tax receipts in 1980 were $500 billion. In 1990, it was $1 trillion. The federal government decreased tax rates in the 1980s and doubled the amount of tax receipts going on from 500 billion to 1 trillion. Now what are tax receipts in the $6 trillion? $6 trillion in the United States right now, I think our total tax receipts. Is it higher than
I
that?
think it's got to be higher. I don't know.
No, I think it's maybe 6 or 7. Somebody can Google it. What are total tax receipts in the United States right now? But it's grown quite a bit. But anyway, I just tell people, I said, not so fast. Don't just assume that when you decrease tax rates, it's going to decrease tax receipts that the federal government collects. And don't just assume that tariffs automatically cause inflation. It's a very, very complicated thing, and there's just a lot of moving parts that goes into. Now, if you decrease tax receipts and we have a recession and that dollar doesn't get turning over, then that's going to have an opposite effect. So
5.23 trillion, 2025 U.S. federal government.
yeah, I think we're probably going to be pushing $6 trillion this year in tax receipts for the federal government. So a little bit more. Anybody have any questions about tight money policy, easy money policy, monetary policy versus fiscal policy? Good terms to know, good things to understand. And yeah, you can go ahead.
Okay. Finish it up with just a few slides to send you home. So investment behavior is always extremely important. It's always going to matter more than the headlines. Headlines are going to draw a lot of attention, kind of invoke some of the fear, some of the panic. But at the end of the day, us as investors, we're trying to be rational. Oftentimes we can be irrational. When the market's high, we want to buy. When the market's low, we want to sell. We got to take that emotion out of the box and let's just think rationally. So avoiding the emotional reactions to the headlines, the market timing, trying to get in and out, based off of certain things. What we want to do is control what we can control. Focus on what we can dictate. Sticking to your plan, asset allocation, savings rate for those of us still working, putting more money maybe in your 401k or your Roth IRA investments. Tax efficiency is a huge one we talk a lot about. Rebalancing the portfolio. So when you're investing in a portfolio and say this starts to grow really a lot and over here not so much, maybe it's time to take some profits here and just bring us back into balance. So rebalancing can be important. Long-term discipline, consistency and long-term discipline, I think those are just tried and true ways to be successful when it comes to investing. So news cycles are there to create fear, there to make you react quickly. But we just want to stay invested, control what we can control. So what can we control? Hit on a few of these, but savings rate, how much money we're putting away in our investments a month or year. Investment allocation, diversification, those kind of stay hand in hand. So we can control how much risk we take with portfolio. Of course, we cannot control how much return we get. But we feel like with adequate risk or, given a certain client, we're doing what we can. It's just the market's gonna do what it's gonna do occasionally. So rebalancing, as I said, staying invested. Out of our control, what the market does, interest rate environment with the Federal Reserve, inflation, of course, economic cycles, all things that are out of control. Now, it's not to say we don't think about them or see them or hear them as we always do, but it's just understanding that those are out of control. We can't focus on that. Let's focus on what we can do ourselves. When Lily, Tim, and I were putting together this presentation, we wanted to talk about headlines and staying away from headlines, making you let decisions. And so later that afternoon on Yahoo Finance, I came across these two articles that were published the same day, literally one on top of the other. And it goes to show that even on a given day, we can see conflicting reports or conflicting articles come from different authors. So one saying that, some stocks are sliding after a ceasefire, one saying that stocks are soaring. So they're there to grab attention. There was a lot of people saying oil is going to go to $200 a barrel. And Maybe it will still, who knows? But that was never our anticipation. But it's there to invoke fear. It's there to be a little bit of that fear monger and get people a little bit scared. So it's one of our favorite charts from a company called First Trust. They put this together and they update this every year. But the theme is there's always a reason not to invest. There's always going to be something going on here in the United States or globally that is, I think I'm going to stay on the sidelines till things calm down. We hear that sometimes. I'm going to wait till things calm down. Well, guess what? By the time things calm down, the market's already reacted and already jumped. So let's some recent examples. I guess what we got here. 9/11, of course, is on there. COVID. There's COVID, that little blimp on the radar. Silicon Valley Bank collapse 2022. U.S. launched a strike on the Iranian nuclear facility. So again, there's always Russia invaded Ukraine. There's always going to be a reason why somebody could convince themselves that I should be on the sidelines. But time and time again, we are rewarded by being long-term investors and just staying in the market.
I keep on going back to that we're a nation of 350 million people and we consume every day, from even sleeping at night. You're still consuming. You're consuming electricity and natural gas, and your insurance is, it's just constantly, you're constantly a consumer. And I don't think that consumption is going to stop. So
there you go.
What's that? Yeah, there you go. Or chocolate. Yeah, or chocolate. Let's Bonnie sells chocolate too, FYI. So thanks a lot, Bonnie. So, but anyway, yeah, we're a nation of consumers, and just think about what it takes to get stuff into your house. I always use the box of cereal thing. If anybody ate cereal or has a box of cereal, think of all the components of that box of cereal and how much it took, how much economic activity did it take for you to get that box of cereal in your cupboard.
There's
blows you away.
Not an article, basically kind of a memo that an economist wrote in the 1950s. It's called iPencil. And the whole thing is it describes every single thing across every single country that went into making that one pencil. You think about everything that's in it. So it's kind of incredible. There's a whole page list of things that went into it. So anything you see here, anything you're doing, there's always economic activity. There's always raw goods, material coming from all over the world that's going into making that. So, we'll go through recessions. We're going to go through economic turbulence, but business and spending continues to go. Now, it might slow for a time being, but that's an economic cycle. So what do you do with this information? Obviously, don't panic during volatility. Stick to your long-term plan. Focus on what we can control and use the market dips as opportunities. That's one of our favorite things is when the market is down, instead of getting a client call in a panic, it's like, hey, the market's down 10%. Should we be buying? Or, hey, I got money on the sidelines. Could we be buying something right now? And that is one of the best calls that we can get, or one of the best things that somebody can say to us, because they flip that psychology. Instead of they're doing what we're taught to do, but how we act differently, because when the market's up, we think we got the Midas touch, as Tim said. When it's down, that's when, really when we should turn around and be looking for opportunities. So market dips create long-term opportunities.
I'm going to point out this guy in the front row. This is back in 2008. Ron came into my office and he looked at me. He says, Tim, America is on sale, because stocks have plummeted over the previous year. Just had to bring that up. Anyway. Hey, everybody. Thanks for coming. That's it. Does anybody have any other questions?
Everybody has SpaceX in the portfolio. How are you guys feeling about that investment?
Well, it's interesting because we did buy some right away on the first day. Everybody is in the black today, but we'll see how SpaceX pans out. I would, yeah, but eventually I'd probably like to buy it. I'm just telling you to beware. It's going to be very, very volatile over these next several months.
Yeah.
And here's a good important thing, and I've told everybody that bought it, is that SpaceX is not a profitable company right now. They're still operating in the red. So
yeah, $2 trillion company, $12 billion in revenue. So they're trading at an unbelievable valuation right now. In fact, one of the biggest in the S&P 500. So
yeah,
we've said just stay patient. In fact, not to toot our own horn, but it's kind of what we were telling people who wanted to buy it or who had interest. It's like, I think what we said was essentially kind of what happens. Like, there's going to be a lot of excitement. You're probably going to see the stock take off a little bit. We'll see it come back down to reality. So here we are, kind of right where it IPO'd. Still really overvalued, because it's still a $2 trillion company. Got out to be a almost three. It was bigger than Amazon at one point. It was the
No
fourth
profits.
biggest company. Yeah. So
But I would not count Elon Musk out. I think with what he's done with Starlink, there's 10,600 satellites orbiting the Earth. And I don't even think he's even touched on what those satellites can do for our quality of life and what that's going to maybe do in the long run. So
it's hard
I-
to put a value on space too. And that's what a
Yeah.
lot of people, I mean, it's
Yeah.
like you can't really value this company like a normal, I get that you can't really value it like a normal company because they are far and away the world leaders in what they do. And so
yeah, yeah, it's just, we'll wait and see. It could turn out to be really, really good. And who knows, maybe it'll turn out to be really, really bad. But anyway, so with that, thanks everybody for coming. We appreciate it. So have a good night.